Well, I think it's useful to define first what financial integration is. The way we tend to measure it is by measuring how many assets in a foreign country domestic residents hold, and also how many assets in the country are held by foreign residents. So, for example, if I buy a share of Santander and I am a resident of the United States, I increase international financial integration because I hold a claim on a bank in Spain. And similarly, if Santander buys a bank in Argentina, that's an increase in integration between Spain and Argentina because one of Argentina's banks is now owned by a Spanish institution. In terms of order of magnitude now, for advanced economies, the amount of claims on foreign countries are often larger than GDP, than the size of the economy. They're often 200% of GDP, something like that. And the liabilities are of the same order of magnitude, broadly speaking. For emerging markets, the numbers are smaller. And of course, if a country is a creditor, there is a bigger difference between the assets and the liabilities. The assets are larger. If the country is a debtor, it's the other way around. I would say there are a series of possible benefits. One, I'm thinking in particular about emerging markets, is that integration may help financial deepening. And what financial deepening does is basically developing the domestic financial system. And what that does is to allow entrepreneurs, firms in the country to access capital markets more easily. They can borrow from a bank or issue a bond, and there are more financial resources from which people with good investment projects can tap. Also, another benefit can come from, say, technology spillovers. So if Volkswagen sets up a plant in the Czech Republic, that may increase productivity in the Czech Republic because there is learning from the sophisticated technology adopted by a firm from a more advanced country. And another form of benefit is what economists call risk sharing. What risk sharing means simply is that if in your portfolio you don't have only claims on your own country firms, but also claims on a different country's firms, you are somewhat less exposed to domestic risk. You have a more diversified portfolio. That's a benefit. Of course, the counterpart to that is that sometimes when a shock hits another country and there is more integration, then everybody is going to be affected a little bit more. So those are the two sides of the coin. Let me take a very simple example, which is the one of the beginning, the subprime crisis. So you had some securities backed by mortgage assets that were packaged and sold to investors, and some of these mortgages were of very low quality and basically predicated on the assumption that house prices would only go up. When house prices slowed and these people found themselves unable to service the mortgages, the pain was not limited to US investors, which would have been the case had there been no integration. And the reason is that many banks of other countries, particularly the UK, France, Germany, Switzerland, had bought these bonds. So clearly the international repercussions have been bigger because more bonds were held outside the United States. At the same time, had everything being held in the United States, you would have had a much more severe, even more severe shock in the US, and that may have had bad repercussions for the world economy anyway. So you have a US source shock which is distributed a bit around the world. What is very different across countries is the type of financial instruments, not just the size of the financial instruments they buy and sell, but also what type. So you have, to go back to the example I gave before, all these mortgage-backed securities backed by the subprime, the bad quality mortgages were basically almost entirely held in advanced economies. So banks in, as I said, in the UK, in Switzerland, in Germany, in France, not really in Spain, but in advanced economies. In contrast, emerging markets were holding primarily treasury bonds in the United States or securities backed by Fannie Mae and Freddie Mac, the big American mortgage guarantors. And those did not take a plunge. So you have really a difference in the typically more sophisticated investors hold instruments that are more complex and sometimes end up being riskier. Also, some countries have a lot of direct investment or portfolio equity investment overseas. They have an equity culture. The United States is one example. While other countries, say for example Japan, tend to hold more bonds because they tend to be more conservative investors overall. There is now